All right, welcome everyone to the Thursday Elite Zoom training. Today I wanted to spend some time doing an overview of Americo financial products. The reason why is that is currently our number one used the carrier and products for us, about 33%, like one third of our business is going with Americo. And there's a couple of reasons. One, we have an instant decision programs so that you can get the clients approved right away and you can find out up front if the client qualifies or not without you having to go through the whole application, put the bank info and everything to hear that they're not approved. So we do like that preliminary underwriting where it gives us a heads up that if the MIB looks good enough to continue with the application or go ahead and stop and we need to look for another option. So to me, especially if you're doing leads, you're doing mortgage protection leads or general life leads, the speed of your business is crucial, right? And if you wanted to get the client to sign up with you, you don't want to take too long because they're going to lose interest or they're going to be discouraged. So able to find out if the client qualifies or not right away is very important. And then if that doesn't work, then we're going to switch to another carrier and you can pivot right away. Okay. So let's look at the Americo products. So we're going to go to agent tools. Six-digit code is 00587. All right, so we're here. Agent tools in Americo.com. This is where you quote and do the application. What I'm gonna do today is I'm gonna use just like a couple of different age to give you as an example. So let's go ahead and go to Nevada, and you can either put the age or the date of birth. You don't have to put both. But always make sure that your calculation of the age is correct because sometimes we just calculated real quick and even if you miss by just 1 year, the price of the plans are different. So you can even put it in the Google if you wanted to and say, what's their current age for May 12, 1989, as an example, right? So we're gonna use age for now, since that's easier. We're gonna use an example with a 40-year-old. Let's first talk about what are some of the available products for a 40-year-old. Pretty much everything. We don't use the Advantage Whole Life just because this one, the price point is quite high and it's not as good as an IUL in terms of the benefit. So that's why we don't really use that. So disregard that. Um, Eagle Select is probably one of the most used final expense or senior whole life for our agents. And the advantage of Eagle Select is that, first of all, the age went down to 40 years old. So you can cover clients between age 40 and 85 years old, which is a big deal. Okay. And when you go click the illustration, so you're going to go ahead and put the age or date of birth, gender, nicotine use, and on the face amount, this is where you're going to choose. And they just upped it to 50,000, they said. Let's see if it's true. Yeah, it's working now. So they increased the death benefit up to 50,000, which is amazing. It used to be 40,000. Now they do 50,000, which is the same as Mutual of Omaha Living Promise. So that's another great thing that they're keep improving their products to help the agents, right? And this accidental death benefit, I think it's a great value because this will double the death benefit if the client dies of an accident like slip and fall or car accident. And let me just show you. So without the accidental death benefit, $50,000 coverage is only 105. So if you have a 40-year-old client who has some pretty big health issues, like they had cancer 5 years ago, or they had a heart attack 3 years ago, those type of clients, even though they're young, they're only in their 40s, this could be a great option. And by adding the accidental, the price goes up to 117. So that's only a $12.26 addition to the base 50,000. So if the client dies of a natural cause or an illness, it's $50,000 payout. If the client dies of an accident because of this accidental death benefit rider, it doubles to $100,000. Okay. And if you wanted to take a look, you can even create a report, an open report, to see the details of what this plan comes with. It breaks it down exactly. But I will give you a heads up. I typically don't do all this detail for a final expense or a mortgage protection client because once you open a can of worms, it is they're gonna have so much question. They're gonna be like, oh, why is cash value at this age, this amount? You don't want to open that. I'm just showing this you as an agent, all right? So that's the way you can actually see how the policy is structured and everything and all the benefits that comes with it. I think this is a really good product for especially clients with a good amount of health issue. And let's just go back to the quoting tool. Let's go to same thing, Nevada 40-year-old. Instant decision term series. I actually quite like Americo's instant decision term series because they have variety of products inside of the term series. If you go to click this illustration and 40-year-old male, non-tobacco, and product type. So there's products, there's quite a lot. CBO stands for cashback option. That means if the client doesn't die in the next 30 years, then the client can get all their money back. And that's just an example. CBO 50. So what is the difference between CBO 100 and CBO 50? CBO 50 is that the client, if they don't die in the next 30 years, they actually get back only half of their money, 50% of their money back. So I usually will never choose this one. Either client gets all their money back or they just don't get it back at all. But they do have that option if you wanted to. But I personally will just show CBO 100 and maybe like a term 100 or 125. So now let's go to the term 125. Term 125, that extra 25 means that if the client dies of an accident, they'll pay 25% over the regular death benefit. So if you wrote $100,000 term 125 and you put 100,000 here, if the client dies of a natural cause or an illness, they still get only 100,000, okay? But if the client dies of an accident, it pays an additional 25%, which is what is 25% of 100,000? That's 25 grand, right? So the family will get $125,000 if the client dies of an accident. Okay. And this pays a better commission for the agents compared to a term 100. Term 100 means that whether you die of a natural cause or an illness or an accident, the family gets the same amount regardless. So if it was a $100,000 policy, they'll pay out the same amount. And the term period, this was another questions from our agents, and I wanted to address this today. Do you see it says 15 years on this one? And then the second one says 15 years with a dash with a 5-year GTD. This means that both of these cover for 15 years, but the first one covers the client with the same level premium, same premium locked in for the 15 years. So the premium does not go up. The 15-year, 5-year GTD means that it goes for 15 years, but the price is only guaranteed. The premium is only guaranteed for 5 years, first 5 years. So as an example, if the policy premium started with $100 5 years is the same, but it's going to go up after that. So, do you think it's a great plan for the client? Most likely not. Only person that I might recommend this to is if you're gonna write this as, let's just say, do you know like people have SBA loan, if they had some kind of a debt liability that they had to pay over the next 5 years and they don't want to spend too much money on a 15-year term. They just want to have a 5-year guarantee locked in period. This is a great plan if they plan to cancel after 5 years. Okay. Do you have a question, Stefan?
Yes, Sean. What's funny you bring that up because I messaged Costas like a few months ago, and I got confirmation on that. He says that some states have to write it that way
Hmm.
by law. And
Hmm.
I asked him if it's ever gone up. He says it's never gone up. So if you're looking for the lowest price point, I'll show you the text message. This happened yesterday.
Oh yeah, that's great.
It has never gone up. He's like, yeah, if you want to sell the lowest, it's like it's never gone up in the history of America. So
Great.
some states they have to write it that way. So I always go if it's a cost issue, I always do the 5 year guaranteed. Yeah, it may change,
Yeah. Not
just
a
yeah,
yeah, the guaranteed is only 5 years, but most likely the price will not change, is what
it
you're
hasn't
saying.
changed. Yeah, they have to
Okay,
write it that
okay,
way
that's
with
great
some
to know.
states. Okay. Yeah,
Yeah, that's
but
great to know. So now my question is this, Stefan, would the commission be the same for the agents?
that's a good question. I gotta look at that.
Yeah,
I gotta look at
it's one of those
that.
things. Yeah, covering all bases.
Yeah, let's look at
Go
that,
ahead.
man.
Yeah,
Good
let me
question.
go through that.
I don't even look
I
at
know.
that, but
You save quite a few dollars, and agent gets like a
right,
25%.
right. I wasn't even
Let's
thinking of
take a
that
look.
too.
Yeah, let's take a look. It should generate. I just put it in
John, you
here.
said the commission on the 125 was better?
Yeah, commission on the term 125 is better than the term 100. They just pay a higher commission because it comes with an additional accidental, which the Americo is charging the client. Okay, let me just see if it doesn't. Yeah, for some reason.
That's a great question, Sean.
Yeah, I always double check this because I want to make sure that agents are not working for free. So term 100, there's really not a difference there that they are showing 5 years versus the regular. So you might still get the full commission on this.
I'm gonna call Americo because this isn't really that updated.
Yeah, yeah.
I'll
So
go ahead double check and let you know. Okay.
yeah. So to answer your question, Raquel, if you see right here, this is the symmetry commission level, 80%, right? And then 85, it goes up. So on the term 125 right here, you get paid the full commission, your contract rate. The term 100 pays 15% less on average. Okay, so you can choose which product you want to sell. Okay. All right. Yeah, great question and great insight, Stefan. Thanks for that. And then let's talk about some of the other ones. So the continuation, this is an interesting thing. So if a client says, "Hey, like I would like a term because I can get a large coverage for a pretty affordable price, but what after if I don't die the next 20 years or 30 years, what happens? Like I lose all the money that I put in and I have no insurance." That's one of the objections in the past. So the continuation, what it does is if you were to get the continuation to be added to your terms, then after the term falls off completely, the client can keep 10% of the death benefit and continue to pay the premium. So that's another great option if a client is worried about, oh, I'm 40 years old and by 70, if I don't die, I am out of insurance. But if you have the continuation, and let's just say the coverage was for 400,000 for a term, the client will keep 10% of that of 40,000 and continue to just pay that as a whole life policy. right? And then continuation 25 means 25% of the death benefit. So that's a little higher, right? So there are these different additional options that client can have to kind of secure their future and lock in their coverage amount early on. That is another way you can benefit. And then payment protector, this is a very interesting product because mortgage protection, a lot of the clients, when you first talk to them and they have no idea about mortgage protection, they're going to say, "Oh, I thought the death benefit went down when the mortgage went down to match the mortgage, right? It's like mortgage is going to go down and the death benefit goes down to match that." That used to be the case. There was plans like that that was offered in the past, but they don't do that anymore. They use typically like a 20, 30-year term to cover the length of the mortgage, and the coverage amount stays the same. It stays level, like a general term life insurance. Now, Americo has a product called the Payment Protector, and this one, it goes down. The death benefit decreases over time as your mortgage goes down, right? But it's not exact. It's not exactly to the client's mortgage payments going, the mortgage amount going down, but it does go down over time. So if a client says, "Hey, I already talked to a few agents, and this is a great way for you to earn their business." If somebody says, "Hey, like I'm specifically looking for mortgage protection that actually the coverage will go down as my mortgage goes down," then you do have that option. You can go to the payment protector, and there's two ways you can set this up. One says benefit amount based on monthly benefits, and there's a benefit amount based on face amount. I most of the time choose the face amount. So what is the difference? If you put the face amount of, let's just say mortgage was 300,000, I put it face amount and put 300,000, it changes to 299,999. It's okay. It's just the software. 30 years. And we said 40-year-old male, right? So almost a $300,000 coverage for a 30-year decreasing term. And I can go down and see how much is it. It's $103 a month. Pretty good. If I go create report and open report, it's going to show you how much lump sum they'll pay out at how many years in of your policy year or what age you are at. So if the client was around 55 years old when the client passed away, the amount that they'll pay out is 160,000, not $299,000 as it started. So the death benefit goes down as the mortgage amount goes down. But at the end, it doesn't go down all the way to zero. So 30-year mark, client will still get 30,395 if the client passes away, but the premium does not go down, by the way. It's still 103. So they're gonna pay 103 when the death benefit is 294, and also same at 30 years in when the coverage is $30,395. This does not have the living benefits, guys. So I'm gonna just show you a comparison. All right, let me just show you a comparison and go back real quick. What's your question, Stefan?
So what if you compare that with just a term
That's what I'm
payment?
doing right now.
Yeah. Okay,
So
cool.
let's just compare with the term 100 as an example. 40 male, and then let's go ahead and do a face amount of 300,000, or yeah, or 300,000. Doesn't matter. 30 years. So only thing we changed was what? The type of product. Instead of the decreasing death benefit, we did a term 100, which pays out $299,999, whether the client dies on the first year or the 30th year. It stays level, right? This is the general term we sell. The price is how much? It's 134. So it's only about $30 difference, right? It's not a lot. So guess what I tell the client? If they insist that they want a decreasing term, I will sell them the payment protector plan because they want the death benefit to go down and they want the cheapest price possible, then I'll show them that. But what I will also say is, hey, John and Mary, just so you know, this is something, if you're my family member, I might recommend this one and this couple reasons. So you can let me know what's best fit for you. So when I open this one, go to create report and open report. And by the way, guys, again, I'm not showing all the details of this to the client. I'm just showing this as an agent for your knowledge and your in the back, your back of your pocket, what you have in terms of the information about this. Okay. So here, take a look at this. This one, 300,000 for 40-year-old male is 134 a month. It's $30 more, but it comes with the critical illness, chronic illness, terminal illness included. So if the client has a heart attack, stroke, cancer, if they were in a long-term care situation, organ failure, things like that, then the family can get the death benefit up front as a living benefit. And on top of that, the death benefit stays level throughout the 30 years. So the client dies on the first year, it's $300,000 payout. If the client dies in the fifth year, 10th year, 20th year, it's all $300,000 pays out. So the family gets paid out more than the mortgage amount owed at the end. Does that make sense? So you can educate the client and say, hey, one plan, you get $300,000 payout, whether you die in the first year or the 30th year, regardless of your mortgage amount. And if the family only owes $100,000 on the mortgage, you can pay off the mortgage for $100,000 and you still give family $200,000 left that they can use to pay for other things and continue with their life. Right? Or, and also it comes with living benefits. So it comes with critical, chronic, and terminal illness. So if you had heart attack, stroke, cancer, major organ failure, things like that, or if you have a long-term care, then we will actually pay the death benefit up front while you're alive to help you. So that's 134. The other one is 103. So it's much cheaper, and this is what you're asking. The death benefit goes down as the mortgage goes down, but the thing is, the death benefit is going to be less over time. That means the family might only be able to pay the mortgage off, and they might not have extra money for your family. And secondly, if you had a heart attack, stroke, cancer, and things like that, this doesn't pay any of that out as a living benefit. So do you like the 134 that comes with the 300,000 entire time through your mortgage and comes with living benefits, or would you like a coverage that goes down as a mortgage protection as it decreases, but the premium is $30 cheaper? So that's kind of a great value proposition there. Charles, you have a question? You're muted, Charles.
I wanted to know about you said you got 299,999. Why do you have 299,999, not 300?
No, because payment protector, this particular illustration, when you put 300,000, they just change it to 299,999.
Oh, so it's not because they won't go higher. It's just
it just automatically does that. Yeah.
so what's the cap on this? How much?
Yeah. So yeah, let me just show you right here. So here, payment protector.
Way less than paying for. Yeah, the way things are going, dude, 11 years from now.
So 450,000 is good. Yeah. So that I believe that's the cap. Yeah, 450K.
Okay.
So 450,000 is the max. Okay. So that is the product called the payment protector. Okay, and then payment protector continuation. This is another product that if you were to, let's just say, let's do the same 300,000 that we were doing before. And do you see that this one, do you remember I told you that if the client doesn't die after the 30 years, what happens to the coverage? If you die after the monthly income
Yes.
benefit period or the continuation benefit period, 10% of the initial lump sum death benefit. So 10%. So what does this mean? We started with a 300,000. Charles, can you mute your line? I think there's a background, like a TV sound. Um, the 300,000 is a death benefit, but it goes down, right? Because it's a payment protector plan. It's a decreasing death benefit. But after the 30 years, the family will still get $30,000 after this is done, and they can keep that policy for the rest of their life. So it's a great option for clients who maybe want to secure after the 30 years and able to keep a policy if they wanted to for 10% of the death benefit that they started with. Okay. And then these are some of the riders. Let me just show you a couple of different riders on this. Do you see it has an accidental death benefit plan? So you can actually, if you add it, you can add a additional accidental death benefit, which is not a lot. It's only 10,000, 25,000. I rather recommend you to write a separate accidental policy for a better value for the client. If you don't have health insurance license, then Americo has a great product, and I wanted to show you that right after this. And if you take a look at this disability income, you can even add a disability income on this one.
Don,
So
are you saying don't do the accidental death with America? Do it a standalone?
no, this is just the rider. This is just the rider, but it only gives you, do you see that it only goes up to 10,000 or 25,000 additional payout for accidental? So
Okay.
it's not a lot, right? So what I will do is then, if you don't have you have a health license, Raquel, but for people who don't have a health license, they can go to this ADB on the term series. It's still the same term series, but it's called ADB, accidental death benefit. And it comes with just the face amount of $1,000 for any kind of death, and that's the base. But that's why health agents can, non-health licensed agent can sell this because it's a life insurance for $1,000, but accidental death benefit amount is a rider. So you can choose 100, 150, 200, or 250,000. So let's just say you wanted to give them a $250,000 accidental policy. It's $48. So if the client dies of a natural cause, it still pays out 1,000. But if the client dies of an accident, it pays out 250,000. That's $48, and you can write this without a health license. Or
Sean,
if you have a license, you go with Mutual of Omaha Guaranteed Advantage, which is cheaper. Go ahead, Veronica.
how is the underwriting on these term policies with Americo?
Americo. Yeah, so I would say the underwriting is pretty decent. Some of the big no-nos for Americo term products is cancer. Cancer is a no-good, no matter how long ago it was, how little it was. If there was a cancer history, they're going to be knocked out of this plan right away. For diabetes, I would say it's pretty lenient, but then they cannot be taking like insulin, and the diabetes have to be diagnosed after 35. So, and then if they just have general blood pressure, cholesterol, diabetes after 35 without insulin, then they should be able to qualify for this.
Thank you.
Okay, you're welcome. All right. So yeah, this ADB is a great option. So if you don't have your health license and you still want to sell an accidental death benefit plan to give them a better coverage so that it's more attractive, then you can always add this on top of like a term 100 or like an IUL, things like that. Okay. Yeah, go ahead, Anna.
I had a question. At the very beginning, you talked about that we use this a lot because if your client has cancer or had cancer like 5 years ago, are you talking like, and then now you just said cancer is a no-go for the term. So what was the one that it was a go for?
Oh yeah, it's a completely different product. So let me go back so I can clarify that. So they're Americo's term products and the IUL is a no-go for cancer
Okay.
previously. client who had cancer. So no matter how little it was or how long it was ago, it doesn't matter. If it's cancer, then the term and the IUL is out. You can't do that. This Eagle Select, you see this right here?
Yes.
Eagle Select is his final expense. This one is okay for cancer.
Okay.
So if you wanted to do that, you can. It starts at age 40. And if you wanted to go to the if you wanted to go and take a look at the underwriting cheat sheet, let's just go ahead and show you so you can kind of see how I would do like an underwriting. So I'll go to cancer, medical condition for cancer. It's a little glitchy today. So Americo. So do you see that Americo? I told you the term and the IUL is declined right away, whereas the Americo Eagle Select whole life, it's okay as long as it was over 2 years ago and it's not a recurrent cancer. Yeah, so that's how we can double check.
Thanks.
Okay, yeah, you're welcome. Yeah, so great products. Eagle Select, Instant Decision Term Series, and lastly, it's Instant Decision IUL. So let's talk about that real quick. This one is one of the best priced IUL in the country. I'm not saying it's necessarily the best in terms of, how would I say it, maybe the growth and all that stuff, but IUL is such a flexible plan, and not everybody wants a max funded IUL that's going to cost them $500, $1,000 a month. Remember, some clients who are reaching out to us, they're strictly looking for mortgage protection. So they don't need a fancy cash value, like maximum building one that they want to retire in. They want something that's going to last them through the mortgage and longer if they, outlive that. And it still has a permanent coverage. So the price never goes up until 120 years old, and the cash value accumulates so later they can even withdraw it if they wanted to, and with living benefits. So that's really the selling point on this. And if you take a look at it, let's just do a 40-year-old male, non-tobacco, and let's just use 300,000 since that's what we've been using. 300,000 is how much? 187.61. So do you remember how much it was for a 40-year-old male for 300,000 for a term 100 with living benefits? It was like $134 or so, right? So now the value proposition to the client is, hey, John, I have two amazing plans for you. Both are great, but let me show you what the benefits are for each of the plans, and you can help me choose what's best for you. One, you have a 30-year mortgage protection plan that's going to cover you for 300,000. And if you had critical, chronic, or terminal illness like heart attack, stroke, cancer, or if you're in a long-term care situation where you can't do 2 out of 6 activities of daily living, then we're going to help you to pay off your home early while you're still alive. But if you don't die or get sick in the next 30 years, then you outlive the policy and the policy goes away. Okay, and that plan is $134 a month. The second plan, I would say it's a better plan because this will cover you for 300,000 throughout your mortgage. But even if you didn't die during the 30-year period, this policy continues for the rest of your life, no matter how long you live. And secondly, you have a cash value that works like a savings inside of your life insurance policy, mortgage protection policy, and later you can withdraw the money tax-free as well. So clients think of it as a protection with some savings on the side. And it comes with all the living benefits. So if you had heart attack, stroke, cancer, and all that stuff happen to you, then we also help you to pay off your home early before you die. And plus, the great thing about this plan is, right now, John, what is the average interest rate you're getting from a savings account? They say, oh, I don't know, 1%. Do you know the national average for a savings account is 0.04% interest? It's nothing. So if you have $10,000 in there, they give you like 4 cents a year. Crazy, right? Do you know what the average interest rate on this plan that the money grows tax-free? It's 8.45% right now. It's over 200 times. So not only you're protecting your family, but also if you didn't die, which we're hoping, right? Or if you don't get sick from terminal, critical, or chronic illness, you're going to have tax-free money that you can withdraw that you can use to supplement your income in the future. Or some clients, they actually, let me ask you a question, John. If you can pay off your home 5 to 10 years early, would that be a benefit to you? How many people do you think will say no? So if you go to the create report, and again, I'm not showing all this right now to the client. This is for my knowledge. If you go down to the tabular detail, based on the non-guaranteed current interest rate is 8.45 that this has performed over the last 20 years. Go to year 25. This is 25 years in of the mortgage. There's $57,604. Client could use this money to pay off their home early, 5 years early, if they wanted to, using this money that has accumulated inside of this policy. Or they didn't pay it off early. They kept this policy for 30 years and there's $80,000 in there now. Maybe they want to use it towards a down payment of another property as a rental property, right? Or they want to just take a small amount as a monthly income for the rest of their life. But this policy continues throughout their lifetime until they're 120 years old. So which one do you think is better for you, John? So I'm just putting it on them now. Do you want just the general mortgage protection that comes with the living benefits, but it covers you for the next 30 years, and if you don't die, it just goes away? Or do you want something that's going to last past the 30 years for the rest of your life, and it has cash value? Why would it make sense for you to put $100 into a savings account right now when the interest is so low that you're not going to gain anything? Why wouldn't you put the $100 into something like this to protect your family? Because instead of doing this, imagine you put $180 into a savings account and you're hoping that nothing's going to happen to me. And I just keep putting $180 into a savings account and not have a mortgage protection. And suddenly you had a heart attack, stroke, or cancer, or you suddenly died. What would that bank account, savings account do for you? It's not going to pay off your home. Your Bank of America or Chase Bank, they're not going to pay off your home. That's for sure. And if you even saved off $10,000, $20,000 in there, what's that going to do for you when you're dealing with cancer, heart attack, and stroke, and you still have a mortgage to pay? So do you see how our smart clients or money savvy clients are doing? They're protecting their assets and they still utilize this savings inside of the policy so that later they can withdraw the money out if they don't die, or they can use it to pay off their home early, and or whatever. You want to go on a vacation after paying off the home, you can do that also. So every time when I'm doing a presentation, I wanted to make sense. I want to make sure that client understands, and if they're smart enough to understand it, then it's a no-brainer for them. Because I just told you, if you were to put $100 into a bank account thinking that, oh, it's insurance, so I don't want to do that and just do this. But now you're putting your family in a financial predicament, and that could potentially make your family lose a house. Why wouldn't you put it into something that grows with higher interest over time and it protects your family? So that's kind of the best way you can present it for a client at around this age, of course. Okay. Any questions?
Yes.
Yeah, you can. You can, Anna. You can get the same thing through Engage Line. Yes. Yes, Nora, it's the same premium after the term. So if you do the continuation, then yes, they keep the 10% of the death benefit, but the premium is the same. Is this just Americo? Yeah, it's Americo. Let's see if there's any other questions. Yeah, payment is the same for the 10%, but it becomes a whole life. It's called instant decision, Elizabeth, because when you sign up the client with the application, you'll find out right away if the client gets approved or not in 10, 15 minutes of doing the application. You have a question, Charles?
You muted me. You muted me. I can't talk.
I did it. I did mute you.
Can you hear me now? Okay. Well, I
Yeah.
want to go back to payment protection. When we go to payment protection, right?
Yeah.
You can put in there what their payment is, and it'll illustrate down the bottom the amount of the mortgage. I mean,
That's
the
a
amount
great
of
question,
coverages.
but it doesn't work quite that way. So
If I
I'll
if
show
I put in there, if I go into payment protection and do it for the payment only, and I say that
doesn't
like
come
they're
out
paying $1,500 a month, will it show me what they're?
Yeah, it doesn't come out the same though. So let me just show you this real quick. So let's go back to the instant decision term series and let's go to payment protector here. So let's just say it was 1,500 monthly, right? Instead of the face amount 300. So let's just say 1,500, right? 30 years, and you go and then the death benefit now is showing 334,000. So I usually go with the face amount because that's what they base it on, the total amount to pay it off. Or if they insist to doing the monthly payments getting paid out, then you can also set it up this way. But I typically solve it with face amount.
So if we do the
And then
if we do the payment protection, because that's an option, does it still have the living benefits? And are the living
no,
benefits only in
no.
are not
Payment
in
protector does
California?
not have any living benefits. That's what I was talking about earlier.
Okay, no living
Missed
benefits.
that part. Yeah, so payment protector doesn't have the living benefits, and that's why the price is cheaper, and
Yeah,
also the death benefit goes down, right?
yeah.
So if you wanted to give client with living benefits, then you will go with the term 100 or the term 125.
And living benefits are not included in California.
Yeah, correct.
But
Let me just go ahead and
critical
double check here.
illnesses, or I mean,
Let me just go ahead and double check it for you. Term 100. And let's do
yeah, let's go back.
yeah, so let's go to California and then put 40. Yeah, let's go to term 100 and do 300,000. Okay, here you go. The living benefits are included with your policy at no extra cost. These rider gives you an access to the early critical, chronic, and terminal illness.
It does include it in California.
I mean, this is what's showing here right now, but maybe you can just double check and look at the agent guideline so you can double check it. Yeah, so it's not showing there, it's only showing terminal. So most likely for the state of California, it's just terminal illness, not the critical and chronic, it seems like. Yeah, it's only listing one compared to the other one was listing both the critical and chronic.
Yeah, yeah.
I would
Okay.
put terminal, it's only terminal illness for this one for California. But the other states are still come with it at no extra cost for everything. Okay. All
Where can we
right.
get a list of the states that living benefits are not in? I know it's not California, but where else? Can I, because I'm always saying, yeah, living benefits. And if I'm calling out in a state that there is not living benefits, I'm saying something wrong.
No, there's living benefits pretty much in every state. I think the only exclusions are California and New York.
Oh, California and New
That
York.
Yeah, but that's it. Everyone else does. So, and to answer your question, Anna, yes, living benefits are included with the IUL that I just showed you. So if a client is like, hey, I want an IUL, but I want an affordable price with living benefits, Americo IUL will smash any other IULs out there in terms of price value, like the premium and the just the value itself for the amount you get. You can't even compare it. FNG, Transamerica, AIG doesn't matter because it's a great price product. If you want to really design it and max fund it, then you could go with like FNG or Transamerica or some other products, but this is more geared towards affordable IUL. So if a client wants an affordable IUL, Americo IUL is great. Mutual of Omaha IUL Express is great. If you want to customize it, FNG IUL is the way I would do it.
And the IUL for California that has living benefits is only Transamerica?
Yeah, yeah. And then NLG. Mhm.
Sean, I have a question.
Yeah.
Hopefully my sound's okay. I'm driving, but
Yeah.
with the continuation product,
Uh-huh.
if they decide to continue, and I normally have just avoided this product because if they want something permanent, I'm looking there. But if they choose to go that route and it converts to a whole, does that mean it converts to building cash value, or does it stay with the same like terms as it did with the like term policy, where it does not build cash value, or does it actually switch to like a whole?
Yeah, great question. So it becomes a whole life with the same premium, but at the 10% of the initial death benefit. But it does still have cash value accumulation and it's for the rest of their life as well. So you can think of it
Okay,
as being converted into like a Eagle Select type of product.
okay, and so yeah, they'll get that 10%. How does that compare? Because I have avoided it, for that reason. How does it compare to? I guess yeah, to like getting a whole policy from the get go.
Yeah, so but it's hard to say because really the reason why client gets it, it's a little different. So if the client can afford like $187 a month, I would recommend them to go with like an IUL with Americo because it gives you a lot larger amount of coverage and it comes with interest. Your money's gonna grow faster, and it's for the rest of your life. But really, the reason why people might do a term 100 with a continuation is because they want to pay less money now, but also leave enough benefit at the end that they could continue with the whole life or let it go at the end of the 30 years. So it's more about what the clients are focusing on. If they want living benefits and if they want a large amount of coverage to not go down after 30 years and they want it for the rest of their life, putting into an IUL is a way better deal for them. But if the client just wants to pay less money now and just have an option open at the end, then the continuation will make sense. But I'm a big I'm a big IUL fan, so I would do IUL, but maybe somebody will
Absolutely.
justify that it's $50, $60 less, so they might go with a term. So it's up to them really.
That makes sense. If I'm understanding correctly, it's sort of this compromise, between the two, which means it's more expensive than just a flat out term, but less
Mhm.
expensive than an IUL. Um,
Yeah.
am I understanding that correctly? It's just kind of a
Yes.
compromise,
It
just in
is.
case.
And honestly, Cami, like if I were to write 100 apps, maybe one if zero is continuation product. So it's not really that something that I used a lot in the past. If the client brings up a concern about, oh, what happens after the term, and they want to make sure they have something after the term, then that's something you could offer. But it might never really come up in your presentation. So you might be just showing a term 100 versus an IUL.
Right.
That
That
makes
makes
sense.
perfect sense. It helps just to understand what's out there and what these products are and mean, just so we can make those decisions. Thank you, Sean.
Yeah, you're welcome. Yeah. Hopefully it was a good training. And yeah, I'll get this uploaded to the Kim Agency YouTube channel. And yeah, you can also find this on Engage Line. I would highly recommend you to get on the Engage Line so that you can really take this business seriously. And we're updating our AI, and it's going to be amazing. We're going to implement ChatGPT, and it's going to happen over the next few weeks, but it's going to be a game changer. So yeah, make sure you jump on that, and you can find all the recording calls and everything like that on there. All right.
Hey, Sean.
Yeah, go ahead.
Jeff. Who? Me or her? I can't hear you, Sean. You're bleeding.